Right, welcome back to my YouTube channel. I'm very super excited bringing you all this video, and I hope you get value from this episode. And my goal for these videos is just to help you get to a point where you can literally become very consistent and very profitable in forex trading. And on today's video, as you've seen from the thumbnail or the title of this video, is how you could stop avoiding fake breakouts in the forex market. And so if you've ever entered a breakout trade, price breaks the level, you jump in confidently, and all of a sudden, boom, the market reverse instantly and stop you out. And this video is for you, right? Today, I'm going to be showing you exactly how to avoid fake breakouts and how smart traders stop donating liquidity to the market. Let's go right into it. First of all, what is fake breakout? You literally have to understand this concept, what fake breakout is. A fake breakout happens when price breaks key support or resistance level. Then traders rush in thinking that the momentum will definitely continue. Then what? Price sharply reverse on them. And usually, why does this happen? Because the market would always try to hunt liquidity, right? Retail traders would always place their stop loss above resistance and below support level, right? Which is very what most retail traders do, right? But now the institutional guys will push price beyond that level to trigger people's stop loss, right? Then the market, then they reverse it back, because if you don't understand this, you will always be exited by liquidity sweep at all market time, right? So why most traders get caught up in this fake breakout thing is that they always will try enter a trade immediately on the candle break. So once the candle break, they won't even let the candle break or close properly before they look at the direction. Usually they are scared of FOMO, fear of missing out. So they just rush in, and what happens? The market would always hung their stop loss. So don't, and usually secondly is they do not wait for confirmation, and sometimes most people get caught up in this because they ignore market structure, forgetting that market would always respect the existing or current structure, and they trade during low volume hours, right? So when they see a breakout and think, oh, this is it, then this is the move, right? The market does not reward your impatience. It will always reward confirmation. So why 5 ways you can avoid fake breakout? Before I share my screen and we'll let's look at, before I share my screen and then we look at a typical example. Number one is 5 ways to avoid a fake breakout is wait for the candle to close. I don't know how to emphasize this, but when I learned this, it literally helped change my life. Never enter a trade while the candle is still forming. It looks very simple, but the practice now that most people find very difficult. Let the candle close above the resistance or below the support level, right? Because the weak candle week would always lie to you. Close candle would always be a very source of confirmation. So when you see a market has been playing for a long time over below a resistance level and you want to go in for a buy, let's say the structure is an uptrend and you want to go into buy, it's very much advisable that you are very much patient and wait for the candle to close, usually the 4 hours time candlestick, to be able to confirm that move. Because it's very better and okay that you are patient and wait for the 4 hours, the higher time frame confirmation to confirm that breakout, than for you to just rush fearing that, oh, you will miss out on this trade. Especially you've seen that price has been resisting over that point at least 4 times, right? So what make you think that that would finally be the breakout? So usually what I do is I try to make sure that I wait for a 4 hours candlestick to close very bullish above my resistance level. Secondly is look for a retest, right? The safest breakout entry is break and retest continuation. So most people, for those of you who do not know what break and retest is, sometimes you guys call it W pattern, M pattern formation, or head and shoulder pattern. So that's just simply, if it's an uptrend, the W pattern is market move up a bit, comes down, goes up, right, and reject a little before it forms like a head and a shoulder, maybe 2 times, retested at least 2 times before it finally break out. That's even the best confirmation. Let's say if it's a downtrend, you're targeting, it's an M pattern. Market moves down, comes up, forms a lower low, lower high before it finally start dropping. That's the best strategy, right? That break and retest. So at least you wait for a break and retest for that continuation. If price breaks a level and come back to retest that level and still hold that level, that confirms trend, right? It breaks and immediately reject. That's a trap. So once it break and it reject, but at the end of the game, whether break and retest, patience is very important, right? So number three is using volume confirmation, right? Breakout without volumes are very suspicious, right? So low volume is like low condition, because what happens is when you are buying and selling, the market moves based on volume. I like you to see the direction of the market by, let's say, there's a weighing scale, and there's something equal. So it's usually equal like this. Then let's assume this is the sellers, this is the buyers, right? So the sellers, right? If seller is very much, the volumes of seller, more the volume of people who are selling at that particular time in that instrument is greater than the number of traders who are putting in their buy orders. What happened? The market will respect the sellers, and the seller wins. And you know what happened? Those people buy, they are going to have their stop loss hit on that trade. So market will always move in that direction of the highest volume. People, direction of the highest volume at any point in time. So when you understand that, you want to look at, is there volume? How do you dictate volume? Is the strength of the candle that is forming at that point. Usually you can see very hammer candles, small candles, and different candle, right? Morning stars, and all of those things. But if it's a bullish candle, you just see a very strong bullish candle just goes up, and like that, it just continues at that level. So usually you want to check the number of volatility that's available at that point in time that you want to enter your position, right? Avoid fake breakouts. And another thing is trading in the right session. You see, Asian session usually would have low volatility and more likely to show you fake out, right? But breakouts during London sessions and New York sessions have very with confluences of what I've mentioned above. We usually have very strong follow through, right? So time matters when you are trading, especially I like trading during the overlap session between New York, London, and New York session. That time I know there's a lot of volatility in the market. There are much people actively trading that time, and so there's usually volume to be able to confirm my entry, right? Usually number five is checking the higher time frame. Before you enter a breakout on the 5 minutes chart, ask yourself, what is the daily time frame saying? What is the 4 hours time frame doing? Right? If higher time frame is bearish and you are buying a breakout on a 5 minutes, you are trading against pressure, right? Because how can a bearish, if a higher time frame showing that the market is bearish and the lower time frame on 5 minutes showing you that it's bullish, and you're trying to do the breakout, it doesn't work. So make sure you align your time frame, right? So before we discuss and I show you the psychology behind breakout, let's look at a very typical example on the forex chart. All right, so this is a gold chart. So this is a gold chart. So this is a gold chart. Um, let's use an empty one. Let's see. Let's see. Oh, okay, so I think my network. So now this is a chart. Let me show you something. So there was a very strong resistance level at this point. When price was at this level, when price was at this level, you could see it. There was a very strong resistance level at this point on this is the 4 hours, right? What did you see here? Market tested this point. Market tested this point, and market got here, right? People were deceived, especially at this level when they saw this small breakout, especially on the lower time frame. It's going to look very massive. But look at the 4 hours. It closed, and the next candle that could form was not big, but most people were strapped on on this place. They were thinking that it would finally break out. Let's go to the 15 minute. Let's see what I'm seeing in the lower time frame. So this is it. This is the 15 minutes time frame. Let's look at it. So you can see here. uh, So what did you see? See what happened in 15 minutes. You see the way the breakout looks very real to be true. What happened? You see, the market start tanking. So if you are using the lower time frame to determine that breakout, and it will tell you that, oh, it's a final breakout. Just imagine you entered immediately and it's going up, and you're expecting it's going to the nearest high. What happened here? See, it start dropping, 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 dropping. But on the 4 hours, if you had used the higher time frame, it's very easy to avoid that fake out. This is it. You just see that this candle close. If you have been patient for this candle to close, you will just automatically know that this thing would not hold true, right? We keep seeing that over and over and over and over the chart, right? The higher time frame will always tell you what is the real, if a fake out is real or it's just the market just is just a fake breakout, right? So always use the higher time frame. You know, most people don't understand that, right? So now the psychology behind breakout is that fake breakout works because of human beings are emotional. They have fear of missing out, and they have impatience, right? And they need to catch the move, right? But understand is that the market will always give you another opportunity. Once you know that your job is not to trade every breakout, your job is to trade high priority stop setup, because it is better to have a missing trade than you can always have another opportunity to enter a trade, but you cannot always have another cap. You cannot, once you blow your account, it is more difficult to get another money to trade another day. But you can always miss an opportunity and have next opportunity, but you can blow your account and you will not have another opportunity, right? So from today, never trade this first break, right? Wait for confirmation, and if you miss it, just let it go. Protecting your capital is very important than catching every move. So if this video has helped you understand fake breakout better, please do well to subscribe to this YouTube channel. And if you are serious about consistently being profitable and not just gambling, we have amazing videos on this channel. But one thing, remember, dear traders, that the market would always punish you for your impatience, but it would always reward your discipline. And if I want to always see you in the next video, please do well to subscribe, and I look forward to seeing you on subsequent episode.